Hey everyone, welcome to this week's edition of What's Driving Token Prices. I'm your host, Katie Talati, Director of Research at Arca. I'm responsible here for analyzing and identifying digital asset and blockchain opportunities as part of our hedge funds. As part of our research, my team and I look at token prices and the market events that act as catalysts for price change. And so today we're going to share with you some events that cause these price changes. So before we get started, just a reminder, this is meant to be commentary. It's not intended to be investment advice, investment research, or recommendation. Please consult your investment professional for your own circumstances. All right, guys, I'm not going to sugarcoat things this week. It is bad. If you have not looked at the market or the news, this is consider this your wake-up call. So I'm going to go through probably the most pressing event on the market. And we have a few other interesting items, but I can tell you there's one thing driving the market right now outside of the macro picture. Okay, so to start, we're going to talk about Luna, obviously, and UST and Bitcoin, because they've all had an impact on each other. Okay, so for those of you who actually don't know or haven't been following the story super closely, over this last weekend, at about Saturday night, an unknown party withdrew $500 million from Anchor Protocol on Terra and sold this UST position. On a low liquidity Saturday night, this broke UST's $1 peg and started a bank run on Anchor and Terra. So if you're not familiar with Anchor and Terra, Terra is a decentralized / algorithmic stablecoin protocol that issues UST, Terra's dollar-pegged stablecoin, in exchange for Luna's, Terra's native token. So UST and Luna are minted and burned based on demand for UST. Anchor is Terra's native lend-borrow platform and was offering an incentivized 20% APY for users to deposit UST in order to grow the UST usage and adoption. So Terra's foundation previously had raised significant capital, and that was supposed to act as a backstop for the peg if it ever did break. This, and then what they did is that they ended up, the assets in reserve were a mixture of Bitcoin and other non-UST stablecoins, and other digital assets. So as the UST dollar peg broke down over the weekend, the Luna Foundation Guard, LFG for short, began lending out assets in their reserve in order to purchase UST off the market to try to restore the peg. Despite this, however, users, likely large institutions based on the dollar amount, continue to withdraw UST from Anchor Protocol and continue to sell that UST on the market, which further put pressure on the peg and causing it to trade below $1. In addition, in tandem, the loaned Bitcoin that was used to purchase Bitcoin was then sold by market makers, leading to the sharp decline in Bitcoin price. And as you can tell, this is all cyclical, right? So as Bitcoin started going down, so did the Luna price, so did the UST price. So they were kind of all feeding into each other. And that's why we saw a cascade of downward pressure on all assets across digital assets in the last few days. So this has caused general de-risking across digital assets. We're currently still watching withdrawals from Anchor. But to give you guys context, before this started, there was 13.2 billion deposited in Anchor. Today, it's at about 3.4 billion. Obviously, this is not really good. I think if you're looking today, you can see things are trading down quite a bit. For people who aren't paying attention 24/7 like some of us, Bitcoin's down 24% on the week. That's a pretty significant decline, really mostly driven by this. UST, a dollar-pegged stablecoin, is down 35%. And actually, we don't really know what it's trading at because the prices have been different across all exchanges that people are trying to arb it out. At one point, it was trading in the 50-cent range. Luna is down 98%. To give you guys context, I believe it started the weekend around 70, and it is currently trading at $1.70. Again, unknown what the exact price is, since prices at every different venue is different right now. That's the case in most volatile markets like today's. So we're continuing to watch this unwind happen and see what impacts it has on the market. But that is the main thing driving token prices this week. So I'm sprinkling in some other ones just so you guys can keep up to date. So ApeCoin. So the ApeCoin, Yuga Labs, the creators of Bored Ape Yacht Club and other related IPs like Mutant Apes, Bored Ape, Kennel Club, all of those, they were launching a NFT mint about 10 days ago on their other side metaverse. So what happened during that mint was that they hadn't optimized their gas contracts correctly. And so a bunch of users ended up spending outrageous amounts of gas to mint land in this NFT sale. After doing so, they basically clogged the Ethereum network. Fees were really high for several hours. Some people paid up to 2 ETH for the mint, which at the time was like, almost, over $5,000. Essentially Ethereum saw over 100 million in Ethereum spent on gas fees during that period, which is insane. So great day for miners, not a great day for users trying to mint the NFTs. So anyway, last week, Yuga Labs decided to do right by the community, and they said that they were going to pay back any of the users for their Ethereum mint fees if they were failed transactions. So essentially, if you tried to mint something and you didn't manage to execute and buy yourself some land, they refunded the fees, which cost them about $265,000. It's still a pretty hefty price tag, but definitely needed to restore some goodwill within the community. Despite this, ApeCoin is down 64% on the week. Okay, next we have Compound. So this is a decentralized lend borrow protocol built based on Ethereum. So this week they actually received a B- credit rating on its treasury from the S&P, which makes it the first DeFi project to be rated by a reputable credit agency. So although the project has, although Compound officially has junk rating, it's important, I think, that traditional finance is becoming increasingly intertwined with digital assets. And we're starting to see some of these more traditional rating agencies and other financial institutions realize that they're going to need to apply their ratings to digital asset projects. So according to Compound, the S&P cited the uncertain regulatory regime for stablecoins, USDC, stablecoin to fiat convertibility risks, Compound's treasury currently limited capital base, and a 4% return obligation. S&P views the Compound protocol, the source of the yield for Compound treasury track record of 0 USDC losses, as partially mitigating the capital risks of the offering. So all in, Compound only down 32% on the week. All right. Last but not least, we have Flow blockchain. So Flow is a layer 1 gaming focused blockchain created by Dapper Labs. They announced last week that they raised a $725 million ecosystem fund for developing projects on the Flow blockchain. So investors in this fund include Dapper Labs, obviously, A16Z, Co2, Union Square Ventures, Greenfield One, Liberty City Ventures, and Coin Fund. All right, guys, that is all I have for you this week. Stay safe out there. I hope you enjoyed our insights. I can't actually say tune in here again next Wednesday. Next Wednesday, we will be having a bye week as Arca is hosting our digital assets conference. If you're interested in joining that virtually to hear me speak, please go to our website to register. Thanks for tuning in. I'll see you 2 weeks from today.